Today we're talking about the new year. As we look at a new year, everyone wants to know how it's going to turn out. So we're going to talk about adapting to economic trends. Niels Bohr said, prediction is very difficult, especially if it's about the future. Warren Buffett said that Americans are in a cycle of fear, which leads to people not wanting to spend and not wanting to make investments, and that leads to more fear. We'll break out of it. It takes time. End of quote. Charles Darwin said, it's not the strongest or the most intelligent who will survive, but those who can best manage change. And that is what this year brings us, is the need to manage change. As we look at the future, our country is very fortunate in that we do have some things that the government spends money on that I happen to like. One of those things is keeping track of the number of births and deaths in our country. What I have on the screen here is referred to as the Immigration Adjusted Birth Index. It comes from the U.S. Census Bureau. We know how many people were born in any given year within our country's population. And that's important for us to know as investors and as business people, because we need to know whether or not we have consumers. Consumers drive our economy, and they have various changes that are predictable at different stages of life. And we're going to show how that impacts you today. Think about your own life. You're somewhere on this graphic. If you're single and still at home, the odds are you don't have a lot of money. Your needs are being met by your parents. If you have income, the odds are strong that you may have had or do still have an allowance, a gift from your parents. You don't have a lot to spend. You're not a big impact on the economy. Once you finally move out, you're on your own. There's a period of singleness, but somewhere in our mid-20s, on average in the United States, we get married. Typically, that's around age 26. And about 2 years later, on average, we have our first child. Just think about it. You leave the parents' home and you need a place to live. Maybe you buddy up with somebody and you're in an apartment. You first get married. You're in an apartment. Very few newlyweds in their 20s have the money to buy a house. It creates a demand for apartments. When the second child arrives, it creates a demand for more space. So somewhere in our early 30s, we typically move out of apartments and into homes. We buy starter homes. We finally recognized the need to have a backyard where our kids can play on the grass instead of on the asphalt. And as the kids get bigger and the dogs get bigger and our incomes grow into our mid-40s, that's when we, if we're going to do so, buy a trade-up home. This happens to be the most expensive stage of life in the family's life cycle. It's the teenagers are expensive, and so is their education. Once the kids are out of the home and off the family dole, we end up being empty nesters. This is where something happens that Dad never thought he would experience. It's called discretionary income. So in our 50s, empty nesters may do some deferred splurge buying, but the reality is they're not too far away from retirement, and they're short of savings, and they're too big in debt. Those two things are going to change. As we move into our 60s, we become concerned about outliving our resources, and our spending habits will change once again. If you have a daughter, or have had one, or may have been a daughter yourself, somewhere around age 8, there's this genetic desire that shows up in our population for Barbie dolls. It's just built in, it seems. And here we can track whether or not there's a rising or falling demand for Barbie dolls. And as we can see from this graph, the number of 8-year-olds in our country is growing, which happens to be good for Mattel and other toy makers that cater to this particular age group. This is predictable. If you have declining child population in that age 8 range, the need or the desire for households to spend money on Barbie dolls falls right along with it. What happens to kids who are 8 years old? They get older. Yep, and we know exactly, not only from medical science but from demographics, that when they hit age 14, which is the highest year of calorie consumption in an adolescent's growth cycle, that mom and dad's budget for salty chips, potato chips, is going to go through the roof. In fact, you may find it's hard to keep the larder full at all. I remember when I was in this age group, I'd come home and eat a family-size can of chili just for my after-school snack. And I had two brothers showing up right after me doing the same thing. So if you've been here, you know what this feels like. So this typically happens, think about it, this is predictable. On average, married at 26, on average, 2 years later as a child, and 14 years later, parents are 42. That's just simple math. We know that's going to happen. Once the kids are gone, I mentioned a moment ago that discretionary income is something that mom and dad experience typically for the first time in their life. From 14 years old, kids get older. Somewhere around 17, 18, 19, they're going to college. If they're going to go to college and you're paying for it, you are going to be really broke. But once the kids are through with school and they're out on their own, hopefully not to come back, your living expenses continue to decline. We need to save more money and we need to get out of debt if we are going to retire. And that typically happens somewhere in our late 40s to early 50s. The government data shows that this is just consistent across all parts of our country. One of the other things that happens after the kids are gone is that you do not have to pretend that going to McDonald's is going out to eat. You can go out to a real restaurant. And it's evident because fast food for lunch declines as people get older. They aren't taking your kids out. You have more choices. You can afford a little bit more. And it may be that your doctor's putting some pressure on you to change your diet. But in any event, what we spend on fast food predictably declines as we age. Once the kids are out of school, you're through paying their college education. Discretionary income typically shows up in the household budget for the first time in the family's life. It is not uncommon for some nice sunny day for dad to sit down with mom and say, "Let's go for a ride." Well, he knows where he's going. He's going to stop at the Harley shop, and he's taking mom along to bring the car home. This has really been good for Harleys because we've had a growing population of boomers in that 45 to 50 age group. But it is not good at the current time or for the decade ahead. The number of households in this age group is going to decline. Demography is destiny, and there's nothing Harley can do to change it. They cannot make the money they have made by selling emblazoned jackets or toy motorcycles. What they make money on are the large, expensive, heavy machines, and there is not an international market for them. They don't work well unless you have a good freeway. Let's take a look at what Harley could do to supplement sales. That would be selling mattresses. Mattresses are in a better channel than motorcycles, big motorcycles. And mattress sales too will decline, but that typically happens later on in the family stage of life. And by the time mattress sales are expected to decline, the number of 45 to 50-year-olds in the economy would begin to pick up again, and Harley's fortune could resurrect themselves. What we see from demographics is that this 45 to 49-year-old group, 50s, somewhere in there, has been in a decline, and it is going to continue to do so. And this chart from Business Insider's Money Game shows that the change occurs around 2022. What we track is adolescents, and when we look at the adolescent growth, we see that change around 2023, 2024. But it's all coming out of the same data. It's just which age group we're looking at. But this is important because these are the people who have the bulk of the discretionary income, and until we get into the next decade, we are not going to see them redirect their money or have people redirecting their money from saving to spending. The next round of adolescence drives our economy, and that change occurs in the mid part of the next decade. Let's look at personal consumption expenditures, because personal consumption is driven by family stage of life. And the crises that we see in the headlines really has very little impact on what happens in the economy. For instance, if we go back into the late 90s, we had several major disruptions in the market. The Asian currency crisis occurred, and there was great concern about default on various government instruments from Asia. It wasn't long after that, and we had long-term capital and the Russian ruble as separate entities actually go through a major collapse. In fact, the first big bailout by our government of a firm that was too big to fail happens to be long-term capital. These happen to be individuals who were smart people, PhDs typically, that had figured out the way the capital markets work. They understood modern portfolio theory well enough to borrow more than $1 billion to invest in the market because they knew how it worked and it was a sure thing. Until, of course, it didn't work and they were bankrupt, and the Fed had to bail out the bank that had lent them the money. This was very disruptive to the market. But as you can see, spending continued to rise. We had adolescents in our population growing and demanding, well, at least asking for new tennis shoes, new tires on the car, new brakes, new fenders, new clothes as they outgrew the old ones. Then we move up to the tech bubble. The tech bubble was supposed to be, remember this, the end of the world. You were going to be going out and living in the bushes, and you needed your own generator and power supply. You needed your own dry food storage. Banks weren't going to work. ATMs weren't going to work. You would be out of cash. Silver and gold were big hawker issues at the time. But spending continued to rise. Then we ended up with 9/11. And if you look at 9/11, while the spending slowed a little bit, this was a period, it didn't go away. And this is a period where, just remember this, the headlines were, we were going to become a cocoon society. We were going to be afraid to go out to dinner. We weren't going to go to the movie theater. We'd stay home and watch DVDs and have our family around us because we wanted that kind of security. But what happened to spending? When the kids needed new tennis shoes, Mom and Dad bought them. The kid got old enough to have a driver's license, you paid for the car insurance and maybe the car repairs. But spending continued, and that continued until we hit the real estate bubble. And that's because we had free money for several years to keep this in place. And then all of a sudden, the people who were making that money available realized they were making a lot of bad deals, and they quit making them. And then we had accountability for our spending, and we are now paying for that. We can see the dip, the little valley here, and that valley is simply because we have run out of other people's money, and the economy has to adapt to the reality of who is going to spend money in our economy, and that number is declining. Anybody could have seen this coming. Even the Mayans saw this coming. We see this Mayan calendar here, and as we can see, best I can decipher, it says we're going over some kind of cliff. Well, yes, it's not the financial cliff. It is the demographic cliff. This demographic cliff is unavoidable. Financial cliffs, well, more so, they could be managed differently. But demographics, you cannot change. Demographics is destiny. Let's take a look at what the Fed is trying to do to fight destiny. In our economy, the Fed is pouring money in at numbers that you and I cannot imagine. So they are technically expanding the amount of money in the economy. And normally we would expect to see a lot of inflation occurring in this environment. However, that is not happening. We don't have demand. Why don't we have demand? We don't have demand because families, households, are trying to adjust to the preparation they must make if they're going to retire with any sense of security. And what does that require? Less spending, less debt. So while the Fed is pouring money into the system, borrowers and lenders are stuffing it back by paying down their debt. They're creating their own financial security, which individually is good for both the household and the business, but collectively, when we have millions of people doing this in our economy, it does have an adverse impact that the Fed cannot overcome. So here's that chart again. We have rising consumer spending, and now we're missing growth. Can the Fed solve this? We do not believe they can. It is simply not possible to change the needs of an aging population. They are what they are, or it is what it is, and it doesn't matter what the politicians or the central bankers want it to be. It won't change until the population reaches a new stage in life. Now, what's this mean to you? It means that you must find some other way to prepare for your own retirement. We all know that, one, Social Security's had problems for years, and two, that central banks are printing money that somewhere needs to be paid back, and our employment situation is weak. From the Washington Post, they recently had an article, Rest in Peace Retirement. 28% of Americans are rating their 401k plans to pay for everyday expenses. And the worst part is this is coming from people in their 40s who are still raising families. It means that their ability to retire is being materially damaged because of their inability to maintain their own household income, or they are overly leveraged and must pay off that debt. So what does that mean to you? It means that your retirement plan must be different than it was 10 years ago. So let's take a look at how most people in their retirement plan deal with the money. It usually ends up in some form of capital markets, stock market or bond market, whether it's U.S. or overseas. And very few people understand that we cannot forecast where the market is going to be because it can disconnect from the real economy. But we do understand the basics of supply and demand. And it doesn't matter whether you're looking at the grocery store or gasoline, stock market works the same way, under the same kinds of pressures. If you're trying to buy summer squash in the winter, you know it's going to be of lower quality and more expensive. If you're trying to buy gas recently, it may cost you an arm and a leg. But if you need it, you'll buy it. If it costs you that much and you can get by without it, you are going to buy less. You're going to drive less. You're going to go to Costco less because it's too far away. You're not going to stock up on stuff. The same thing that drives those prices is driving stock market prices. And it doesn't matter whether it's an individual company or whether it's a sector, an industry, or a major asset class. If you have buyers in the market, prices will rise. If you have sellers in the market, prices will fall. It's an auction, and that's what we must understand. In this chart, we're taking a look at the spending wave, which is basically the number of adolescents in a household. And you can see that we are currently in a downward trend. The number of households with adolescents who determine the amount of discretionary spending in the economy is declining. And it's going to decline until the middle of the next decade. Warren Buffett was right. This will eventually go away. It just takes time. And to us, it looks like it's about another 10 years before adolescent population will begin to rise at the time when their parents have rising income. And our economy, unlike any other economy in the Western world, has its salvation in the growing birth rate and the future adolescent population that we have built into our system, because our kids or grandkids today are having babies. And if you see somebody pushing a baby stroller with 2 or 3 kids in it in the mall, you go up and thank them, because that's the future of your Social Security program in your country. Let's take a look at where you've probably been over the last decade and a portion, last 13 years. Here we have the Standard & Poor's S&P 500 index, and we can see from 2000, we got back up into levels around the 2007 and 8 mark, and then that market collapsed, and we've been working our way back up. But this is the seesaw, teeter-totter effect, the sideways channel, if you will, where people get frustrated because they are correct. They have not been making a lot of progress when they just simply look at where they have been over the last 10 years. Many of them moved into real estate in the middle of the last decade, only to find that they are now reaping the same reward of the tech bubble that preceded them. Here's another chart. We've been here before. This is the bear market of the 60s and 70s. And what we can see in here is a similar up and down sawtooth sideways pattern. Make an advance, give it back up, make an advance, give it back up. But during this almost 2-decade run, what we had were 4 major bull market recoveries, right along with the bear market losses that occurred. In this environment, successful investors were not encumbered with current modern portfolio theory. They simply made decisions about risk, reward opportunity, and it didn't matter whether it was U.S., overseas, large company, small company, fixed income. It was an evaluation of the investment market and the flexibility to go where opportunity presented itself. That is not true today. Those restrictions that did not exist in that environment have been imposed with nothing more than sales material to support them in the current decade, actually the last couple of decades. Another place where we've watched this pattern unfold is in Japan. Japan has been in a bear market for more than 2 decades now. Their market peaked in 1989. And in the 80s, if you happen to have worked for a major company, it was not uncommon to find the major management being sent to Japan to find out how they ran such successful companies in a global marketplace. And in that environment, late 80s, Japan was the largest economic market in the world. They aren't anymore, and population has been aging, adolescents in the household have been declining, and there's nothing the government has been able to do to stimulate that and reverse the change. They are now in quantitative easing number 10. And recently, the new government has told the Bank of Japan that if they don't solve this, the government's going to take it over and they will no longer be an independent central bank. It'll be politically run. So what happens throughout this period of time? What we see are there's some major rallies, but there are also periods of major risk, which should be avoided and moved away from. Holding on and hoping things get better will not solve the Japanese or your problem. When you look at investments, there are 6 major asset classes, and if you have an advisor or a website that you use to look at your pie chart, what kind of risk do you think you want to assume? These are the major asset classes that are typically included in that. U.S. stocks, domestic equity, U.S. fixed income, bonds. Sometimes you'll have currency. You will have international equity. You have cash, and some models will have some commodities. Relative strength is a means of looking at the trading activity and the price action in these asset classes and evaluating whether they are strong or weak. It's kind of looking at a horse race after the starting gun has gone off, and at any one point in time you can take a picture and figure out which horse is in the lead and which one is lagging. And relative strength in the stock market, which has been around for more than a century, does the same thing. It's just today, computers make this much easier than it did a few decades ago. Our approach in looking at the market and managing risk is to keep portfolios concentrated in the top 2 asset classes. And at the time I did this, which we graphed this one in November, number 1 and number 2 were U.S. equities and fixed income. There are some numbers there in the next line down that show the count number. When the count number is high, that's strong. If it's low, it's weak. We want to stay with the ones that are leading the pack, not the ones that are bringing up the rear. So when we look at asset classes, we want to start with a top-down approach. Which of these should we own? Are they strong? Are they strong enough to own to justify not being in cash? We want to look at the asset class that is currently in season and focus that in our portfolio. So step 1 is to create an inventory. We recommend the use of exchange-traded funds because they represent all the asset classes. They are inexpensive to own and inexpensive to replace when one needs to be sold and another one added to your account. As a dynamic process, You look at relative strength to determine where they stand on the list, and then you look at each of your possible investments. What's the individual relative strength analysis in each asset class gives us from a cumulative tally as a ranking number. From a defensive standpoint, most people, particularly as they age, believe that their risk profile should be lowered. And to do that, we look at whether or not the assets should be held or should you be in cash. That's a regular, frequent decision that should be analyzed. What's important to understand is that risk in the market has nothing to do with your age. Does the market get riskier because you get older? No, it does not. In fact, if I went back to the graph of the 60s and 70s, the people who were very conservative and bought a lot of bonds in the late 60s lost their retirement purchasing power over the next decade and a half. That was terrible to be conservative as you moved into retirement in an asset class that had high risk, bonds. What's your greatest fear? Probably losing money. You don't want to go through 2001 or 2008 again, and nor do we. Can you avoid all losses? The answer is no. Well, yes. You can put all your money in the bank if it's a bank that's too big to fail. You know the government will eventually bail you out. At least that's your assumption. But you don't have any return. So what are you going to do? You can't save enough without returns to retire. If you're going to be in the markets, the question then is, how do I get out of things that don't work? You must be active in monitoring what you do and not get married to your portfolio positions. This is a model from Guggenheim Special Opportunities where we can see that what we would expect to happen in a bell curve is most trading occurs in the center of activity, and there's some small gains and some small losses. Unlike modern portfolio theory, which says that when your winners start to arise, you sell them and buy your losers because eventually they will change places in the race. Relative strength says that when you have a winner, your horse is leading the pack in the final stretch. You don't get off of him. You stay with him to go across the finish line. If you are on a losing horse that's bringing up the rear, you do want to get off of him. So what this model shows is that simply using mathematical analysis of relative strength, we want to walk away from our losses and limit the downside exposure. But when we have winners, we want to stay with them as long as we can. It is our opinion that by being flexible in your portfolio management and not being married to a pie chart, that your portfolio can make adjustments to the reality of a changing and dynamic marketplace. Whether the U.S. consumer or the Chinese consumer or a European consumer is driving the market should not matter. It is important to know, however, where they are and what is happening. If you have money coming into the market in commodities, you should own some. If it's leaving bonds, you should not own them. If it comes back in to international, that's where you want to be, and you need to have the flexibility to make those changes. If you don't, then kind of like Alice in Wonderland, it won't matter where you go because anywhere will get you there. I have another slide here that basically regraphs where we are in terms of the consumer spending cycle. And we see that in the early years, we come out of home, we get colleges, we get demand for offices, apartments, shopping centers, starter homes, trade-up homes, peak in spending, vacation homes, retirement homes. If you think about this as a baby boomer, or if your folks were baby boomers, when they came into this marketplace, and they were actually, when they came into school, in elementary school, we had too few elementary schools and too few teachers. In the 50s and 60s, there was a huge demand to build educational facilities and recruit teachers. As we moved down the line, when they became independent, and they got married, they needed shopping centers and apartments. When they got more income, they needed starter homes. They have had a huge demand at every stage of life. The kids behind them, the number of children they had, are fewer in number by 9 million. That's a huge hole. There are not enough X generation kids to make up for the spending that occurred driven by the boomers, their parents. That will change. Warren Buffett's right about that. It will change. It just takes more time. And another decade of flip-flopping markets, high returns, high risk, low returns, low risk. These are going to change, and they will come up again. But opportunity is not gone. We have taken a look at using the basic relative strength model and concentrating on asset classes. And what we have found going back through the last decade, the beginning of 2000, is that the market, S&P 500, has returned a little over a 6% return. That's for 13 years. It is no wonder you are discouraged with where you are in your retirement portfolio. In order to have been in the winning position over that 13 years, you would have been 100% in commodities, and the odds are you would never have done that, and no advisor would have recommended it either. But what we see in the colored boxes are that by staying with the dominant asset class and being willing to change, we can improve those returns significantly, and we can maintain generally a lower risk profile because we're watching for risk and adapting when it occurs. If you have questions, give me an email, don@doncreech.com. We'd be glad to respond and answer questions.